join me in welcoming our next panel, which will consider the private credit investment interest in litigation funding. If we can ask the panelists to please introduce themselves, but also tell us a little bit more on your investment strategy.
Good morning, everyone. Can everyone hear me? Is my mic on?
I'm not sure.
Yeah, I don't know if it's on. Can you hear me? No.
No. Maybe, shall we start from...
Do I have a microphone? Hi, is that working? Yeah. So should I start?
Yes, please.
Yes. Hi, everyone. So I'm Bjorn Tessiore. I'm a partner at a firm called Metric Capital. We are a bit different. We're somewhere in between a private equity fund and a private credit fund. So private equity model. So one of the issues was raised on the last panel. You know, it's a fixed duration fund. But within that, we do everything from senior secured debt to controlled private equity. And so we're very opportunistic. We manage about 4 billion euros across a few different pockets. We have been, and I have been, active in litigation funding for about 13 years. However, been doing actually less and less. So we did more when, had you done this conference 13 years ago, I don't think there would have been quite this many people. And that's when we were more active. So we've actually gotten less active more recently. But it remains an industry that we're very interested in and trying to find the right risk return, which is sometimes a challenge.
Thank you.
Hi, Brian Roth, can you hear me? From Rocade Capital. We are based in, I'm CEO and CIO. We are based in the US, primarily a direct lender to law firms. We got started in 2014. We've deployed about $1.5 billion in the space since we launched. We tend to focus on what I would consider the more predictable end of the spectrum of litigation outcomes. So we look at situations that are not quite post-settlement, but post-binary. So we look at, or maybe more repeatable outcomes. So we look at areas like late stage product liability mass tort. We look at things like that are repeatable, like personal injury, medical malpractice, those areas. And so, we tend to use a more analytical approach to data-driven approach to underwriting assets. We do a bottoms-up valuation of a law firm's assets, and then we structure a financing solution that is, credit-based, looks more like an asset-based lending structure. Here in the UK, we are partnered with Windward, so we also do more traditional commercial litigation funding through that structure. In the UK, Europe, and Australia, we also tend to focus with an eye towards more mature sort of litigation opportunities.
Thank you.
Good morning, Hugo Lestiboudois. I'm a portfolio manager at Victory Park Capital. So we're an asset-based lender out of Chicago in the US. And we're actually the private credit arm of global asset manager Janus Henderson. So within the legal space, we have a dedicated suite of funds specialized in legal credit. So we don't do any single case funding or any of the binary risk either. So we focus on lending to law firms on a recourse and unrecourse basis against large diversified portfolios of cases, as well as to corporates who are owners of legal assets. Everything we do at Victory Park is asset-based lending. Legal used to be a strategy within sort of 11 plus sectors that we lend against, and was spun out as a dedicated strategy in 2018, and still sort of sits within the same operational platform. It just has a sort of a team of dedicated PMs. Everything we do has a maturity and an interest rate, generally speaking, so we are in the credit world, and we tend to favor shorter duration exposures in the space, so call it 3 to 4 year loans that are our sweet spot, and we do lend on a senior secured basis in pretty much every single situation. Generally speaking, we're pretty flexible in terms of the type of opportunities we can lend against, so long as there's the diversification in the asset pool that we're evaluating. So we're not restricted to lending to law firms, really any legal asset out there, or any firm that derives revenues from legal situation is sort of within the scope of opportunities we can entertain. And we have been using insurance as well as a sort of form of credit enhancement, which may be necessary when portfolios or asset pools are a bit more concentrated than our typical loans. So we can definitely use structuring and all the tools that really private credit offers to provide flexible capital to the legal services industry.
My name is Neil Purslow. I'm a founder of Therium Capital Management, so pure play funder, but I'm here because at the beginning of this week we launched Therium Capital Advisors. Therium Capital Advisors is a fusion, if you like, between litigation finance investing and investment banking. And what we exist to do is to take clients who are claimants, who are law firms or corporates, to take an opportunity and turn that into an investable proposition that we will then take out for them to a wide range of institutional investors, pure play litigation funders, of course, but also the wider audience, including the credit funds.
Good morning, everyone. My name is Michael Gulliford. I run a firm called Soryn IP Capital Management. We are a US-based firm. We manage private credit funds in the US that are dedicated solely to investing in opportunities where intellectual property, particularly patents, is really the main part of the value proposition. You know, I've heard from a number of folks since I landed on Monday that IP and patents is kind of a scary word to a lot of people in the financing space. You know, we've solely focused on this area since 2016. It's been our thesis since the beginning that the right way to approach patents is through a credit strategy, where you can work with more sophisticated companies with very large patent portfolios, and if structured right, put together what we think are fairly downside protected deals that generate cash flow during the life of the investment and hopefully resolve in 4 years or less. The typical counterparty for us is generally, I would say, on the more sophisticated end of the spectrum as a patent owning company. Instead of maybe 1 or 2 patents, they probably have hundreds, if not thousands of patents. And I find myself at these litigation finance conferences because while we never set out to be in the litigation finance business, we're IP specialists, it's very difficult to license your intellectual property, no matter how big you are as a company, without some form of litigation. It's how parties of all sizes sort of agree on fair market value. And so the credit strategy is the one that we found to be sort of most appropriate for that. And what's been interesting in the IP space is there's really a big push to Europe. There have just been some significant developments in the last 2 years, really with the UPC. And it's really, I think, brought those of us who are in IP much more to Europe and out of the US than we used to be.
Thank you. So there is obviously a lot of interest from private credit in the litigation funding space. We are contacted almost on a weekly basis from different fronts, from the US, from Australia, Europe, who would like to enter the space using different structures. So question to everyone on the panel, but maybe starting with Hugo, what do you think drives this interest of private credit funds in the litigation funding space?
Yeah, I mean, so it's interesting because at Victory Park, we did have like a generalist asset-backed structure, asset-backed credit fund, and we did focus on legal specifically. So we had that thought process a few years ago, where first of all, you know, everybody knows about the decorrelating element of litigation finance, but also just comparing legal assets to other sorts of financial assets. You were able to extract probably 500 to 600 basis points of extra spread for really comparable terms on the exact same sort of instrument. And that's not a function of the companies being worse or the borrowers being worse. It's just a function of less efficiency in the market. I mean, it is a very, very fragmented market. There's tons of jurisdictions, and within each jurisdiction, tons of different case types and law firms and operating models. So it is very, very inefficient from that perspective. There's no sort of single source of coverage. And it's generally still an area that large credit funds don't, I mean, when I say large, I mean, call it the mega credit funds, don't spend a lot of time on. That may change. A few of them have entered the space recently, but so that also provides a little bit more pricing power, but also, more importantly, you know, just ability to negotiate the covenants and her downside protection, sort of the features that you need there to structure robust loans. So that's been sort of the driving point. But we did have to set up a specifically dedicated team, and that's the only team that has its own set of portfolio managers within Victory Park. All the other asset classes that we cover are covered by the same team, which is a generalist team. So it does require a lot of focus to not make the sort of the usual mistakes in the sector. It does require appetite as well from investment committees and just operational members in the team to get up to speed on the specificities of the asset class. So it's a lot of work, but overall we think that the spread is worth it, and the sort of the lender-friendly terms that you can extract are worth it, and the decorrelation certainly is worth it.
Thank you. Bjorn?
Yeah, I think, I mean, first and foremost, why people look at the industry, I think, is the promise of very high returns, right? I mean, you don't see, I don't know, any other industry where you go out on the face of it with this sort of very high level returns. And obviously that's because of what Hugo was saying, that it's a very inefficient market because there aren't that many players. It's very fragmented, it's, you know, lots of different niches, and so it's hard to make it a very functioning market. Then obviously the flaw a little bit was raised on the last panel has been the long delays, which is the flip side of that. So, but the thing that people are really interested in is the high returns and the uncorrelated returns, right? So you're not betting on interest rates or the world economy. That's really the key, I think.
And are those returns actually achievable?
I mean, people in this room will know better than me, but what I've seen is that the returns on the whole are actually relatively good, and more or less, you know, maybe not quite as high as hoped, but that's rare in any industry. But then there's the delay, that is the real key, which I've seen in almost everything we've looked at. You know, looking at it 3 years later, you just see that it didn't happen as fast as anyone thought. Yeah.
Brian, would you agree?
Sure, so I mean, I agree with what everyone said so far. I think maybe looking at it from a different perspective, the reason that you're seeing interest from private credit, you know, investment management at its core is really trying to maximize your yield or your return by taking the, you know, minimal amount of incremental risk. And I think as, you know, private credit investors, the private credit markets have really just sort of exploded since the global financial crisis. Non-bank financial institutions looking for, you know, seeking attractive risk-adjusted returns. And so where they're looking for that incremental yield is in spaces where they're complex, they're hard to source assets, they're hard to underwrite, you need a high degree of expertise, as Michael was pointing out, to be able to manage over the long run. And so that, you know, litigation finance really ticks all those boxes of, you know, there's also an illiquidity, you know, premium that you'll see. And all that together is what, you know, in the private credit world, they say is, you know, the complexity premium. And so that allows you to sort of source higher, you know, risk-adjusted returns. As far as are they achievable, I mean, I think, you know, private credit it's not necessarily that every investment or an investment in the space is going to be 100% private credit or 100% equity. You're seeing sort of a mix. And so private credit enters the space through other managers. They might fund the funders, they might fund portfolios, they might look at, you know, insurance-wrapped portfolios. Sometimes they'll come in direct through like co-investment structures. But, you know, if you can segment the yield in the or the risk in the space, you'll see private credit attached to sort of the lower end of the risk spectrum. And it's already here, and I think it's growing.
And just maybe to follow up on this, so do you find your preferred structures? How do you come in? Is it portfolio? Is it equity? Is it you know, buildings, portfolio of single cases? And how does this correspond to your investment strategy, I guess?
So the way we invest is really doing, you know, bottoms up, you know, sort of asset-based, you know, scoring of individual line item litigations, but we're taking a basket of litigation risk and putting some structure on top of that. So you really build in a lot of downside protection. You know, manager selection is key. You know, so you make sure you're investing with specialists, with good litigators, good operators, focus on, you know, cost and, you know, operational flexibility. And we can be flexible on structure. Each situation is a little bit different. So, you know, we try to match the return opportunity. You know, a lot of folks have mentioned duration. That's obviously, you know, a very important, you know, again, if you're lending against a large portfolio that's diversified across a number of situations, you know, we don't need every asset to monetize before our credit, you know, is retired.
Thank you. And maybe going to the valuation process, Hugo, how do you actually go through the valuation in the underwriting process? How do you value legal assets comparing to your other classes, and get comfortable with the binary outcome of this investment potentially? And then how do you pitch it to your investors? Explaining that, yeah, you know, that's a great industry to invest in.
Yeah, I mean, valuation, interestingly, we're not purchasing the assets, we're lending against them, but valuation is still what we spend the most time on. I mean, our investment committee, our LPs, they always ask us, are you comfortable with the attachment point on your loan? Do you have enough headroom? Are you confident that that LTV is actually the LTV? What's the collateral worth? This is probably 90% of the conversation that we're having. It is not, well, there's no single model to value legal assets. I mean, every type of litigation out there has its own sort of way of progressing, has its own procedural mechanisms, its own milestones, and so you have to factor all of that in. So we do have, in-house within the team, ex-seasoned litigators who have their own area of expertise, and so they can underwrite and try to put a value on sort of the assets themselves, and where we don't have that expertise in-house, that may be in certain European jurisdictions or even within US, certain case types, we will go out and sort of complement our internal diligence with third-party experts that may be academics, that may be litigators in the space, maybe economists. So it's very much the way most private equity, private credit firms will undertake diligence. There's internal diligence and external diligence, and I think we follow that process. But at the end of the day, we need to be comfortable, and not just comfortable, as close to certain as possible on sort of our entry loan to value and where it's expected to peak. And because we are drawing covenants around that. It has huge implications for a law firm or a borrower to exceed these covenants and limits, because we do have control over certain entities when we lend or the assets. So there's also an interesting dynamic. Every party is incentivized to agree on a valuation, because it has implication from a modern perspective and potential enforcement perspective. So it's a long process, and we do rely on third-party experts when we need to. I mean, you have to be humble. Litigation is just extremely complex to value.
Thank you. Brian, Bjorn, would you agree? Is this how you do the valuation process as well?
Yeah, I mean, look, I think the guiding light for valuation in the space should be fair market value, but how do you find fair market value when assets don't trade in the space and they're originated and held by one funder throughout its lifetime? So I think it's a little bit hard, but I think the way, for us, valuation I think is pretty straightforward. In a credit product, I can only earn my principal and interest, so that's kind of the ceiling of how we're going to value things. But we also score the underlying litigation in terms of both, time frame, and value, and then we sort of discount that back at the expected yield. And I think that's how we think about it. Is what would another investor pay to step into your shoes? So I think you have to look at your portfolio and think, if I have an idea of what I expect to collect. If I were offered, $100 for that, is that too low? I would never trade it there, or that's a great price. I would sell it. You should be able to answer no to kind of both of those questions, where it falls somewhere in between, and that's how you know you're kind of in a fair price.
Thank you. Bjorn?
Yeah, I think, the process of valuation is as they said, right? But I think one interesting thing is actually more of a question for the rest of the panel is, I think what would be really helpful to the industry is if there was more consistency in how things are valued on the books of funders, but also if there was some secondary market and there was a bit of movement in these assets back and forth, because that would alleviate a lot. I think the previous panel mentioned the issue of the mismatched duration, right? Where you're buying assets that you think will take 5 years, might take 10, and you're borrowing 5-year money to fund it. That's obviously a problem. But if you had a way that you could actually sell after 5 years and there was an active secondary market, I think that would be extremely helpful to that, and that would unlock more of the sort of cheaper private credit money. But yeah, I'm not aware of much activity on that.
It's interesting, and we were discussing at a pre-panel call with the secondary market panel that's coming in later, whether you can be selling under par, obviously, and syndicating, but also whether there was any experience in the industry of selling over the par value, because you expect the investment actually to go well. So that's I think, an interesting discussion for the later panel. Michael, what about IP legal assets? How do you usually present them?
Yeah, when it comes to IP, and apologies to the economists or the damages experts in the room. My experience, having been doing this a long time, is that generally the valuations or the projections of damages are off by a lot, right? Sometimes 10x, sometimes 20x. It's been fairly surprising to us since we started this. When we look at an IP opportunity, we're essentially forgetting about what could a case lead to in ultimate damages. It's great that a patent could theoretically make $100 or $200 million. That's frankly a disaster of a result. If that's probably going to take 4, 5, 6 years to achieve. We're more interested in companies that can license their IP through litigation for more reasonable sums. Maybe it's a license for $15 million, for $20 million, for $25 million. In aggregate, that's a very attractive investment. So just one word of caution, I guess, for anyone looking at IP. When you hear from great law firms talking about hundreds of millions of dollars in damages, I think you could almost be sure as a rule that it's not, and that it's probably quite a bit less than that, and even potentially zero, frankly, if not looked at the right way.
Thank you. Moving on to our next topic. So we've discussed why litigation funding is interesting for private credit and what drives this interest. So I wanted to flip it and to discuss how private credit investors differentiate themselves from traditional funders. A little bit picking up on what Susan said earlier, that private credit would fund something that we traditional funders wouldn't look at. So some response to this here, and what do we think would be the differentiating factor? Is this the pricing model, the structures, the sectors, types of claims?
I would actually disagree with that statement. I would say it's the opposite. I would say generally litigation finance with more of an equity mentality, like big reward, possible zero, in my experience, is more likely to fund opportunities that we as private credit investors would not. Right, and this all goes to cost of capital. If you're a litigation finance investor, you're approaching the space as an equity investor. Typically, you're looking for multiples on your money. You're probably managing your portfolio that way. You'll have zeros, but you're going to have multiples as well. We as private credit investors cannot afford losses. Right, we are operating at an interest rate. Depending on the collateral package, the insurance, it's a much more modest cost of capital than litigation finance. So what we cannot afford as credit investors, we can't afford zeros, right? We can maybe afford an investment that goes a little sideways, but maybe it gets our principal back at worst. And so I would actually say it's the opposite, at least it should be. But if you're a private credit investor, you should be, frankly, passing on a lot of opportunities that I think the more equity-minded side of litigation finance would pursue, because we really can't afford to have zeros.
That's interesting. Hugo, Brian?
I mean, in a way, I'd agree with Susan that there are situations that are not suitable in legal investing for credit. I mean, it doesn't make sense in most instances to provide a loan against a single litigation unless it's settled and sort of money is about to be funded in an escrow or has been funded. So for sure, if you're entering the litigation finance space with a credit mandate and you're funding single cases, it's a risky endeavor. Now, when you are entering the market with a proper credit underwriting approach, you shouldn't be doing these trades, and then we're falling back to what Michael just described. But I would say in terms of value and competition with funders, value we bring relative to funder or competition with traditional funders, I think there's a few things there. First of all, we're complementary, I would say, to litigation funding. There are a lot of opportunities where we are lending to a firm and they have third-party funding on a bunch of their cases because the use of our loan is not 100% dedicated to or restricted to case expenses or expert or court costs. A firm can use our loan to support OPEX or growth initiatives, open a new office, hire people, pay for technology, change their CMS, you name it. So we can be complementary and attached to sort of the residual economics of a law firm after they've repaid their third-party funder. So in that sense, we're actually helping third-party funders having better counterparties as law firms that are more robust, have a better balance sheet, can attract talent, whatnot. So we're complementary in that sense. We can also be sort of a graduation from litigation funding for certain firms who get to a scale where they have dozens, if not sometimes hundreds of cases, and they're able to run a single financing process instead of having to fund every single case individually. So it's just a question of how they manage resources and if they're able to achieve better cost of capital by blending a portfolio and financing on a portfolio versus single cases. So there's sort of an evolution, and that's particularly true in high volume litigation practices, call it personal injury, asbestos, consumer litigation firms. They tend to sort of start with very expensive capital, and as track record builds and the teams and portfolios grow, they're able to sort of tap cheaper capital, and then they'll graduate from our capital, be it through banking lines or credit or securitization markets. That's sort of a firm maturing. So we're not necessarily competing, and I think we don't usually compete with litigation funders. There's a nice sort of synergy between litigation funding and legal credit.
Thank you. And Bjorn, Brian, do you see usually you competing against litigation funders or other private credit funds, or sort of both?
Yeah, I mean, I think it's a different return profile, right? So private credit is, I think, more efficient capital, seeking a little bit lower return than you would see for single case funding. So I think what we provide is sort of that layer of structure in between, by taking opportunities, again, pooling them into a sort of basket of risk and taking that more diversified portfolio, adding some structure, getting some downside protection. So we don't typically see litigation funders so much. I agree with Hugo. Sometimes law firms will have third-party funding on the side that's non-recourse, in addition to a recourse facility that helps them sort of make their dollars go a little bit further. But we often get asked by law firms, for help funding a specific case or a new opportunity for them. And from our perspective, they're asking for the most expensive capital in the space. So we talk to them about how to access more efficient, lower cost capital, and so they're usually willing to work with us on what they need to do, sort of get the structure in place that, as Michael said, make sure we eliminate the zeros to the extent that we can do that.
Thank you.
Yeah, I was just going to say, I don't think that competition directly exists, in the sense that, I mean, if a private credit fund is funding direct litigation on a non-recourse basis, they're doing something wrong, I think. So, but where there might be is where you have a funder where the private credit is an alternative to the LPs. So there's a funder who maybe hasn't raised the fund and says, I have this portfolio, I want to fund it. And then you're not competing directly, you're still aligning yourself with somebody who knows what they're doing. And that's where I think that's a bit easier, more likely to happen. But I don't see the private credit investors taking the role of a litigation funder directly.
Thank you. And Neil, you've launched Therium advising practice. Do you think that the private credit would, in your view, compete with traditional funding, or it would take the niche as maybe Mez Fund took from the banks after Lehman? How do you think this relationship would play out?
Yeah, so the reason we made this shift is really to do with where we see the money coming from into the space. So I think if you wind back about 10 years and you look at where the funds were, who was backing the funds, it was mostly asset allocators, it was endowment funds, it was US state retirement schemes, those kinds of investors who were coming into a fund in the kind of that Rob described, matching the asset, patient capital, sitting waiting for the returns. They've kind of pulled back a little bit. They're still there, but they've pulled back to some degree, partly to do with issues around the space, the durations that we've talked about, and also to do with some wider macroeconomic issues as well. But on the other hand, we've seen a lot of investor interest coming in through professional investors, particularly the credit funds. When Brian mentioned about the rise in private credit since the global financial crisis, and particularly so in the last 5 years or so when interest rates have gone up. We've seen huge inflows coming into that space from those asset allocators, same asset allocators, and a great interest in this space because they see it as a species of private credit, it's asset-backed financing and so on. So there's absolutely money available for the space, but it's very bespoke. And this isn't just, I should say, private credit, it's also hedge funds like Sarah's, it's people with a distressed debt background, it's people with a special sits background as well. But this pool of investors are very diverse. They think very specifically about their strategy. They've got particular approaches. even amongst, say, a private credit type audience, that's not homogenous at all. They will have very different ways of wanting to think about this, approach it, the way they underwrite it, and so on. So in order to tap that capital, it requires a much more bespoke, much more sophisticated approach. I think gone are the days when a lawyer has produced a bit of a note, they've got their opinion from counsel, they pick up the phone to the funder they met at the drinks last week and say, do you want to do it? That is a very outdated approach. That probably isn't serving the clients best these days, and it's certainly not the way to access this sort of wider investor audience. You need a better approach, and that's what I think we're aiming to do. So that's to try to drive the quality, the investment proposition that's going out. That should drive the quality of the investor discussion as well, because it's better targeted, it's better thought through. It should access this wider pool of capital, accessing investors who want to see things presented differently. It should also create more competitions. We can run a process and create competition between investors as they come into something that's properly well prepared. But equally, it can also do the opposite. It can facilitate co-funding and syndication, which again allows to build up meet a large budget, for instance, across a number of investors and help the market work together, which is something it's historically not done. So I see the private credit piece coming into the space as the future, but incredibly helpful across the whole thing.
Thank you. And just to touch upon regulatory uncertainty in the UK market, point that was discussed at the earlier panel, you obviously look at this either from US or from the European position. So has this uncertainty sort of scared away a little bit your investment in the market or interest in the UK market, or are we comfortable and we're just using different structures to address those uncertainties?
I think it's a bit of both. I think it has had a cooling effect. You mentioned the stats earlier about the CAT and the huge drop-off in cases issued in the CAT. So I think certainly it's had in some pockets, it's had a very chilling effect. I'm not sure it's caused people to pull back from the market completely. I think more to do with the shift of where money comes from, and for the reasons I've just described, rather than necessarily these regulatory points. But they're definitely a headwind. They're definitely very unhelpful, and they don't signal government support for the space, which is, again, very unhelpful. So, that comes back to the Packard point about government stepping up and doing something about that. So I think there's a little bit of that in the space, causing investors to be cautious, but it's very much around the specifics.
Mm-hmm. And Michael, Hugo, what do you think from sort of your US perspective?
Yeah, I can speak to the US. I think from the US, when it comes to the financing world, there's 2 points of concern and uncertainty when it comes to regulatory barriers. There's these new tax issues that Sarah was speaking about that Senator Tillis recently introduced. And there's also sort of disclosure issues, right? These are both concerns. I think on the tax front, it's a long way to go. It was a surprise to all of us. I know we were in the middle of raising the latest fund, and all of a sudden woke up one day and thought, how could this possibly happen, right? Like a tax that no one saw coming that affects litigation finance. This is the worst. I think it has a long way to play out. I can say Senator Tillis, ironically, is I'd say the most pro-patent senator in the United States Senate. I know that from experience. I think his staff was a little dismayed to hear the effect that this tax could have on patent owners and IP owners. So I think it has a long way to go before it becomes law. On the disclosure side, I think that's a more evolving set of issues in the United States. There is certainly a trend towards disclosure of, at a minimum, the identity of a funder's presence, as well as potentially of the agreement itself. It's still venue specific, and it's even judge specific. In Delaware, for instance, in the United States, the chief judge demands a heck of a lot of disclosure when you file a case there. But what's interesting from the private credit side is a lot of these disclosure orders exempt recourse facilities from disclosure. For instance, in Delaware, the standing order is essentially if you have a non-recourse litigation finance facility, you then have to go disclose the funder and whether there's control, et cetera, et cetera. That doesn't apply to recourse facilities. And so it'll be interesting to see if that trend continues.
Thank you. Hugo?
Yeah, look, we've certainly followed in every jurisdiction, regulatory events or meaningful case law coming out of the courts. but overall, with the instruments that we use to fund, we don't use litigation funding agreements. We do just provide pretty boring senior loans overall, I would say. If you look at our docs and you just substitute litigation for aircraft or whatever, it would look the same. The pledges and the securities that we register would differ because of the nature of the assets, but overall, we are just providing, in most of what we do, corporate loans, and the borrower happens to be a law firm, and that law firm doesn't necessarily pay us from contingency fees. They also have hourly fees. They advise, they do a bunch of stuff. So we've been less affected, I would say, and we were still putting out term sheets and investing during the whole Tillis debate. PACCAR, if anything, has created a dynamic where law firms tend to query us directly rather than try to get cases funded, because their DBAs are not at risk, and that's what we attach against. So that's been generating a lot of sort of opportunities for Victory Park to do business outside of the U.S. certainly, and that's true of every reform out there. Think about the Representative Action Directive and its transposition in Europe, where certain jurisdictions have seen cap on litigation funders' returns. Again, that's not really affecting us. So because our cost of capital is lower and our structures are a bit more traditional loans, I would say, our worries in terms of regulation typically are more around, is non-bank lending possible in such a jurisdiction? Is there a banking monopoly? What's withholding tax look like on interest? These are more traditional lenders' concerns on structuring and regulation, I would say.
Thank you. Bjorn, what about UK versus Europe? I guess you have a broader outlook. Is Europe becoming more attractive given UK uncertainty? Or?
I struggle to answer the question because I don't have a full view of the market broadly. What I can say is, we've looked at something in Europe a couple of years ago, which was really interesting. But it wasn't. The regulation worked, and it's sort of the market backdrop worked. The reason it was really interesting was that it was a niche player that had a real angle. So sort of from a fundamental business perspective, it was attractive. So I don't know. The UK, even though litigation funding, I think, has ways to mature, is obviously ahead of the curve. So I think in those markets where you have a less developed market, you can find potentially even better opportunities because there's less, even less competition than there is here.
On insurance, because we're seeing a lot of, demand for the CPI insurance. Has anyone here used or considered using capital protection insurance?
We, as not surprisingly, as credit investors, looking to enhance the collateral in our facilities, have looked very favorably upon the insurance markets and the evolution of the insurance markets. We've done a lot with insurance. It's been interesting to see the evolution. I think we're on version 2.0 or 3.0 of the market. Maybe it's 3.0. In the intellectual property space, I think a lot of the policies actually that were placed had to do with IP type situations, more on the judgment preservation type side, right? Where you would have a judgment and then you would insure a certain portion of that judgment. I think those of us on the financing space thought that, I guess, we had the better of that trade. The risk involved in the appellate court in America is significant with having large damages verdicts affirmed. And unfortunately, the insurers have learned that, I think, the hard way. And so that product has fairly, I think, just evaporated. Fortunately, it's evolved, I think, into insurer appetite for more diversified opportunities, either a law firm with a lot of cases or a company that is licensing an entire industry, not a single point of failure, but an entire industry that can be licensed. We're seeing quite a bit of eagerness to put facilities around those types of situations, albeit they're significantly more expensive than they used to be. And now the insurers are participating in the upside, almost like a funder, right, as early as they can. So it's interesting, thankfully, that it hasn't gone away. And then I guess the third product that we've recently experimented with is protecting actual loans to companies that aren't even in litigation necessarily, but they're generating royalties from IP deals. We've now seen the insurance markets. We just did a fairly bespoke one recently, willing to wrap those kinds of deals with, I think, pretty attractive timelines of like 4 years, 5 years, to be able to submit if something goes wrong.
Interesting.
Yeah.
You good?
Yeah, sure. So, yeah, we see CPI as being a very useful structuring tool. It's a way in which we can adjust the risk profile to be able to create something that give certain investors access into a particular type of legal asset. So we can give them downside protection that gets it into the mandate, and then it opens up that pool of capital. So that's very helpful. Just picking up something that was said on the earlier panel, what it isn't is, of course, a substitute for good underwriting and a good quality asset in the first place. And so that's very key. Again, it goes back to the asset quality. You've got to have the asset quality first. But then once you've got that, then I think it is a tool that we can use to create deals and create access to capital.
I really agree with that last point, and just sort of piggybacking on that. It's called CPI, but really what we're trying to protect is not really sort of the downside, it's more duration. So for us, sometimes in jurisdictions where we know courts may take a while, but there are extremely good cases on liability, we will use insurance to mitigate essentially a default risk on our loan. My mandate requires me to have a maturity date on everything I do, and our funds are typically shorter than litigation finance funds because our LPs are private credit LPs. So we need to have these maturities in place, and sometimes the only way we can get our IC on board with saying, well, we'll get repaid within year 5 or year 6 is to basically have that sort of secondary layer of repayment. We wouldn't do a deal where we think there's a risk of principal loss at underwriting. That's very important. And we don't use insurance as a substitute for diversification, for example. I don't think that's really the play, because then again, like, premium will be higher, it wouldn't fit within our overall cost of capital, so it's all linked. But interestingly, insurance is also something we use to mitigate a risk in private credit, which is refinancing risk. We find that if a law firm has matured after 2-3 years being in the portfolio, plus has some capital protection insurance on some or all of its assets, it's much easier to engage in conversations with new lenders who may come in with cheaper financing, or simply just get comfortable with the refinancing scenario. So it's also a good way to hedge or mitigate that risk, which is refinancing risk. So it's pretty versatile, and as everybody said, it's extremely bespoke. So this is something we really appreciate from the insurance market is they sort of sit down and they're able to every time come up with something that's really sort of adapted to the business model and the structure we're trying to put in place. So they've been extremely good partners to us, I would say.
Thank you. And just as a final question, I guess, to each panelist, so what are your predictions for 2026? Do you think private credit would stay in the litigation funding industry, take a niche or expand, or maybe switch to other asset classes? Maybe starting with Bjorn and going back to him.
Well, I would say you think you take a big step back to look at that and say if interest rates are trending down, then I think there'll be more interest, because the lower the rates are, the more demand there is for these sort of quirkier assets, and this is still definitely a quirky asset. So I think there's a decent chance that there will be more interest and that people try to find ways to make it fit and mitigate the duration or the sort of duration mismatch and try and make it more suitable to typical sort of mass market private credit. So I would say yes, I think so.
Yeah, sure. I don't know about necessarily in 2026, but I think over the long term, if you look at any mature asset class, there's more capital in the form of credit instruments than there are equity instruments. For example, if you think about the private equity markets and the LBO side, it's the KKRs of the world that get the headlines, but the lion's share of the capital comes from the banks and the leverage providers. So I think there's going to be a gravitation towards that over time. What we're seeing is every year that goes by, there's more lived experience in the space. So there's more track record, there's more outcomes that folks can underwrite and really understand the risk that they're taking. And then I think that allows private credit really to sort of grow in the space.
One theme that we see really as promising for private credit is something that we've seen in private equity or other asset classes is NAV lending to litigation funders. So there's a lot of single case funders, also have drawdown funds with closed-ended structures, and they need to return money to investors. They may need to, expand their dry powder. We're out there providing facilities to funders as well to help with that at a cost of capital that works with their own promised returns. So that's something that we've seen a lot of with the sort of third and fourth vintages of a lot of funders coming to maturity. So that's just something that we see a lot of, and we've actually integrated NAV lending to legal funding platforms as one of the sectors that we're actively pursuing with our origination team. So that's a theme, I would say, that we can see continuing for 2026, and where private credit hopefully will be useful to the legal funding market.
Okay.
Yeah, I agree. I absolutely see private credit playing a huge role. I think that's partly a function of the weight of money that's sitting there. So much money's flowed into these funds that is going to be looking for deployment opportunities, and there's only so many senior loans you can make to corporates. So I think that that simply will encourage it into legal finance. So I mean that's welcome. But I think it's also a reflection of the sophistication of the space now. I mean, you can tell from the kind of tone of this conversation, talking about valuations, talking about the degree of risk people want to take, the degree of return they want, where they want to sit in the structure, and so on, as opposed to, is it yes, is it no? If it's yes, it's a capital plus 3x, please. That, again, the pricing is and the risk taking is very much more carefully calibrated here, and I don't see that returning. I think that's welcome as well.
I think it's a big maybe, frankly. Having been raising capital for the latest funds, and you have a pretty institutional LP base, and talking to these allocators, what I know from experience is that there right now is a lot more interest from the private side, private credit allocation bucket, than there is, say, litigation finance. I think what I hear a lot is, please don't mention the word litigation finance. When we talk today, let's talk about private credit, how that applies to litigation-centric investments. So there's a lot more money available in private credit, and as was mentioned, there's only so many direct lending opportunities available, right? So that lends itself to niche, alternative, uncorrelated areas of private credit. We clearly fit in that, but at the same time, a true private credit allocator investor is allergic to lack of solid collateral packages. They're allergic to deals that take too long. They're allergic to deals that don't generate return during the life of the investment at a minimum, right? And so I think unless the industry can put together structures that ultimately deliver on these hallmarks of private credit, right now it's an attractive place for a lot of that capital to flow to. I think whether it continues to flow will really depend on the kind of structures we can put together to deliver those kinds of allocators what they're looking for.
Thank you. I'm sorry, I said it's the last question, but maybe one last question. So what do we then, to follow up on this, what do we need to see, what the private credit would want to see to sort of stay long-term in this sector? You've obviously mentioned a few. Hugo, maybe throw this to you.
Yeah, one thing I would say that our sector, our segment of private credit is missing is a good bank for the legal sector. I'm doing some free advertising, I guess, for Neil here, but I was actually pretty excited when he told me about his venture, because we need people who know law firms to basically help law firms raise capital. Just like at some point there's certain desks of investment banks specialized in tech to be able to speak to the right investors and represent the firms correctly. I think this is something that's clearly missing in our ecosystem, and there's a very good sort of intermediary sector in litigation funding now, in insurance as well, very professional that knows both the demand and the supply side. I think we're lacking that in private credit. So hopefully this will make the market a bit more efficient, and probably will just make the conditions a bit more favorable to borrowers, as well as we have to worry less about certain refinancing events or potential sales of collateral, you name it. So that's something that a wish, at least for us, would be to see a bit of a better infrastructure on this side of the market.
Excellent, thank you. Any questions for the panel? Okay, well, thank you very much.